Now, recently we ran a poll right here on CNBC. About 3,000 people responded. What we wanted to know was, in terms of where to put your money in 2009, where was your money going, or where do you plan to put it? 40% said they were going to put it into U.S. equities. 11% said into Asian stocks. 26% said into commodities, including gold. 17% said into cash. And 5.8% said they're putting the money into bonds. All right, let's get back to our trio of pros. And Kirby Daley first in Hong Kong. You know, I think it's probably fair to say, Kirby, that from the last chunk of talk that we were doing just before we went to the break, most of the people sitting here are, if not bears, at least bearish and still cautious. But you know, and you've noticed this, I'm sure, on this very network, we've had an increasing number of analysts who are saying not just trade what's left of this bear market correction, this bear market rally, but also you can start taking a 2 to 3 year view on a valuation basis, and at the end of which, cross your fingers, you may end up with a nice pile. But I mean, Chris and I were talking, if anybody out there can say they even have a 1 year view with any clarity, they must have godlike abilities that you know, none of us so far have achieved.
That's exactly right. Emphasis on cross your fingers. If you want to take that view, that's fine. Let's get to brass tacks, as you like to say. We need to go back in history to the 1930s to get anywhere near a situation economically which we're dealing with now. And if anyone thinks that in the 1930s, in the Great Depression, that when Keynesian economics took hold, that we were out of this in a year or 2 or 3 and back to the lofty valuations that we were before that, they're out of their minds. This is going to take a number of years. We had a combustible combination that put us in the level of consumption that we had, that drove earnings, that drove the world economy. And we're so far from that, that to think that the stimulus packages are going to get equities, 40% of people think that they're going to make money in equities in 2009, they're severely misguided. It really is scary, because just to say one thing, people think we clocked in the lows last November. Those lows are barely below the lows of 2001. So if you want to compare the situation now, in 2001, we didn't have the decimation of wealth that we have now. We didn't have the frozen up credit markets that we have now.
You're thinking we're in for a series of new lows this year then, for equities at least, right?
Yeah, we're absolutely in for a series of new lows this year, even into 2010. I'm not saying short it today. There could be a bear market rally, but absolutely do not build your portfolio in equities at today's levels.
Understood. Chris, broadly then, you're saying this is still a trading market, especially for you?
Yes, absolutely. I mean, looking at the results of that survey, if that tells me anything, there's an obvious trade there. It's sell U.S. equities and buy bonds. We're still talking, the fact that people are talking about a bond bubble means that we're actually not in one. It's inevitably with bubbles, it's only by the time we get to the stage of, well, this is going on forever, that we actually finally are in a bubble. And I think we're actually a long way away from it.
Interesting stuff. Okay, I mean, the asset classes that we ran through in the poll, equities, commodities, cash, and bonds. One thing that we didn't ask folks, because I guess it's sort of out of the reach of a lot of people, alternative investments, hedge funds. Aaron, I mean, of course, a lot of funds got killed last year. One of the very few strategies that made money was managed futures, exactly what you do. You say that some of your funds are up 75%. Can managed futures still make money in a market like this year?
Absolutely. I mean, if we look at this poll, I think the best choice down the list is probably gold and commodities. But if I was taking the poll, I'd have to answer none of the above. Because it's just proof that the best kept secret on Wall Street today is managed futures. It's basically an undiscovered asset class. Since 1980, managed futures outperformed all of those assets listed in the poll. Had an average return of 15 to 16% since 1980. So the smart money, the high net worth investors knows that managed futures is the best asset class to generate compound returns in the long run.
And what's most interesting to me is, and we've talked before, you guys use no leverage at all, is that right? Still?
There's a natural leverage facility provided by the futures market. So a managed futures fund doesn't have to take any kind of loan. At Superfund, we don't borrow any kind of money, and most of our competitors that are managed futures funds don't borrow any money. But there's a natural facility that is given by the futures market. Actually, on 100% of the assets that we manage, we get interest income. We actually get paid for 100% of the assets that we manage.
All right, Kurt, back to you in Hong Kong. I mean, your prime brokerage side, of course, provides the leverage for a lot of hedge funds. This year, how are things looking? It's probably not as easy to get the kind of leverage that they used to get.
No, absolutely. I mean, costs have gone up all around, and that has to be passed on to our customer as well. And that's why we've seen any hedge fund strategy that is leverage dependent is having a far tougher time than in, strategies like managed futures. In managed futures, as Aaron was alluding to, a lot of the funds for $100 million, if you have a $100 million fund, usually only 4 to 5 million of that it has to be used for margins. The rest of it just sits in treasuries and makes money. So I call it a black hole of leverage. Yeah. Those strategies are going to flourish in the coming environment, and leverage-dependent strategies are going to be more hurt. I'm sure Chris has a lot to say about this as well.
Okay, how much leverage are you using?
We typically use very little leverage. On average, our leverage is around 0.4 to 0.5 times assets under management. Okay. So it's inherently a lot less even than the managed futures fund that Aaron will be using.
Indeed. Okay, tell you what, look, this is pretty blunt and right out there, but when we get right down to it, managed futures made a lot of money for some people last year. Sell me on, let's say, your currency fund versus managed futures. Or should you have both?
I think the key to look for is risk-adjusted returns. Yeah. A super fund have a great track record. They also have a very, very high volatility. If you're willing to take that volatility and suffer through some potentially...
But that's what you do with your
Absolutely
FX
not.
fund.
We've actually, the three partners at Rhicon have been trading our own capital since 1998. So we ourselves are very heavily invested in strategies. The way we want to trade our own money, it just happens we trade our investors' money exactly the same way. So our Sharpe ratio is more in the region of 1.4, which is typically very high for discretionary trading strategy. Yeah. And our largest peak to trough has only ever been 5%.
I'll be darned.
And if you're happy to take that, get that for double-digit returns, then I'm happy to provide it.
All right, interesting stuff. Okay, Chris, Aaron, and Kurt will be back with the three of you coming up in just a bit. We'll go for a quick break. We'll be right back on this Asia Market Week special, Beating the Odds.
Well, we think